Good morning, Probians, on this cold and frosty winter morning. Our speaker this morning is Dr. Jim Menefee, who has a Bachelor of Economics and a Master of Commerce from the University of Melbourne and a PhD in Applied Economics from Stanford University, USA. So he's very well qualified to talk to us on economic matters. He has worked closely with Australian corporate leaders, helping them to understand the domestic and international environments in which their businesses operate during his 7 years as Chief Economist of the Boston Consulting Group. Jim is currently the Program Director for Productivity Growth at the highly respected Grattan Institute, an independent Melbourne think tank for economic solutions. Please welcome Jim to address us on Australian investment in a low growth world.
Have had. Even so, our growth pace has been lower in recent years than it was in the early 2000s. So that period from the late 1990s to 2007 really stand out now as a period of very, very unusually stable and strong economic growth. That set a lot of community expectations after a while. And in recent years, with a pace of little more than half of that golden era growth rate on a per capita basis, we really have been in a different economic world. But nevertheless, the sort of negative results that you've seen in some of the rich world, we haven't experienced to the same extent. What this chart shows is that for a commodity exporting country with really strongly varying commodity prices, income can deviate from GDP. So if you have a period where commodity prices are rising, purchasing power for Australians will rise faster than GDP. Conversely, when you're in a period where commodity prices are tending to fall, then our purchasing power falls compared to GDP. And so as the commodity prices have come off, combined with relatively slow GDP, actually national income per person has gone backwards over the last 5 years. Turning to inflation. So our inflation rate is below the RBA's target range of 2 to 3%. There are different measures depending on whether you look at everything that makes up the CPI or you split out the most variable bits. But in any event, we're clearly running a little slower than the RBA would like. Yeah. Yeah, so different countries' central banks set different targets. Many of them set a target of 2. European Central Bank wants to hit about 2 or a little lower. Australia, over the long run, in Australia, the RBA sets a target of between 2 and 3. There have been periods where it's been higher than that. So it's not a concern if it deviates for a period. But if you have a prolonged period where inflation is below the target and where other measures such as output or employment are also weaker than you would like, then you do have to start asking questions. And much of the rich world has been in that world, rather than, as you say, rather than in a world where you've got inflation above target or growth rates above target. We're certainly not in that world. One important aspect of the slowdown around the world has been that investment has been very weak. And Australia again stands out from the pack very strongly in this regard. Because this chart goes back to 1960, so the period, the last decade of Australia here on the right, but can see we had an enormous growth in mining investment. Non-mining investment hasn't been that different from the rest of the world's experience in recent years, but still quite markedly different from the rest of the world. And then my final slide on the Australian experience is that the combination of that low interest rate world and relatively weak income growth has meant that house prices to income have changed in a way that we haven't seen for many, many years. And this is an experience which some other countries have experienced to some extent. So, for example, Canada has had an experience that's similar to this. But in a sense, this is one of the manifestations of the peculiar way in which this global environment of low interest rates, combined with the fact that our income growth has held up, we've had strong population growth, has contributed to a very, very strong growth in asset prices. Okay, so what's going on? What explains this troika of low growth, low interest rates and low inflation? First, I've got a few slides on what I call the structural causes of low growth and low interest rates. If you're in a world where population is ageing, where largely mass education has been achieved for the workforce, and where potentially technology is not delivering products that are really driving productivity, then you're going to be in a world of relatively low output growth. Second, if you're in a world where ageing and maybe inequality is boosting how much people want to save, at least somewhere in the world, it doesn't have to be in every economy, and if you're in a world where manufacturing costs are falling so that capital goods have become a lot cheaper, then the interest rate that will keep desired savings equal to desired investment is going to be lower than it would have been otherwise. Think about the interest rate as a way to balance incentives for people to save and invest. So if you don't need to spend as much to build your capital stock because capital goods are cheap on the one hand, but you've got people who want to save a lot because they're expecting to live longer, then the combination of those two things will tend to drive down the interest rates. These are two of the big factors that appear to be structural factors that appear to have driven down economic growth on the left and interest rates on the right. Let me just take you through some of the evidence. So here's a chart showing that on the left you've got the OECD, the rich countries, on the right the whole world, that populations around the world are ageing. Now that's a good thing. That's associated with lower rates of inflow, so we're having declining fertility, which is a good thing, and we're also having longer lifespans, and that's an excellent thing as well. But the fact of the matter is both of those things tend to drive a higher savings rate. Let me now turn to productivity. Productivity growth varies a lot over time for reasons that are not well understood. In the US, productivity growth was strongest in the middle of last century. That was a long time ago. And so on the face of it, you might say, well, you know, the big changes have been over for a long time. But in fact, there are shorter period cycles as well. So what I've done on this chart is to show total factor productivity, which is a measure of output divided by an index of all inputs, not just labour, but also capital services. I've indexed it to 1 in 1950, and I've charted Australia, which is the dark line, the US, which is yellow, and in orange is all of the high income economies. And the striking thing to me is how closely these measures track across these different economies or groups of economies. So Australia's experience really hasn't been very different from the rest of the high income world. We had a period of very strong productivity growth until about 1970. Then there was the era of stagflation through the mid-1970s and a period of structural reform in the 80s. And then possibly associated with the internet and finally getting computing really embedded in a whole set of industries. We had rapid productivity growth from the early 1990s until the mid-2000s. And then from the mid-2000s, we've had very weak productivity growth. Now, some of this cyclical, if you like, these long-run shifts are probably associated with the cyclical factors, macroeconomic factors like inflation and so forth. But it also looks as if there might be a role from the underlying technology. There are just periods where waves of technology are heavily exploited. And we seem to currently be in one where, regardless of what's happening in the labs, what's happening on the ground is not yet showing up strongly in the productivity statistics. Now to the point about interest rates. Now there are always multiple factors that drives interest rates. This is a summary of one study that tried to estimate what the interest rate that would give full employment would be throughout the last 55 years in the US, and you can see that there's been a slow and steady decline over that half century, and with a sharp drop downwards during the financial crisis. But the point is that most of the decline over that period is not related to crisis-like effects. It's related to things like the demography, potentially the changing prices of capital goods, which has been very strong over the last 15 or so years with the rise of China as a manufacturer. There might also be other factors relating to, you know, the much deeper capital markets that have made it easier for the two sides to get together. Now, cyclical factors have also been very important in recent years, and I guess the claim that I'm making is that those cyclical factors can play an enduring role. So another way to think about that is if you have a bad recession, it can produce lasting effects, scarring type effects. So the story that I would tell is that in the lead up to the financial crisis, we had a set of financial misregulations, which I can go through in a second. In the aftermath, policymakers were slow to respond for various reasons, and as a result, we had low investment, people not getting labour market experience, and that has tended to lead to low productivity growth. So that's the high level story. Now the detail is effectively that during that lead up, you would recall there was a period where economic growth was very stable, risk spreads were very compressed, people were quite optimistic, they felt that a lot of the technocratic solutions were working very well, and as a result risks were taken that were not visible at the time. And when all of those things blew up, policymakers then were either slow to respond, so output was starting to fall, but central banks were slow to cut rates. In an environment where the natural interest rate was already pretty low, you could bump into zero as a policymaker, and it's difficult to go below zero. You can go a little bit below zero on some interest rates, but you might like to have interest rates of -3 or -4 according to the models, but you can't achieve that in the real world. And then as inflation comes down, that tends to push up real interest rates, even if your nominal interest rates are very low. And there's a role of essentially government austerity, particularly in some of the Eurozone, where the central bank isn't unable to respond to the conditions in individual countries. When you've got the private sector deleveraging, that tends to take away from aggregate demand. And then as I said, if as a result of all of those things, firms see relatively weak demand, the banks are not too keen to lend, so firms don't invest very much, and that was a very, very strong effect in the US for 3 or 4 years, and it's been even stronger in the Eurozone. Then effectively you've got firms that are not picking up on the latest technology and their capital stock is wearing out, and there's a similar process that goes through the labour market. And so I think one of the things that economists have learned is that a big enough cycle, you won't get back to the trend, right? So if you have a big enough hit away from what you expected trend growth to be, then you're not going to get back to that old trend, and we've seen that very strongly. So what's the evidence for that? Well, again, I've shown you this chart already, but you can just see the lasting difference in growth rates in many economies after the recession. This was not a situation where you had a bump with above trend growth that got you back to the old trend. We might be back to something in some cases close to the old growth rate, but we're not getting that above trend growth. So inflation was very low. When you've got this very low inflation rate, that tends to, as I said, to push up the real interest rate that firms are facing. And then this is one way to show that recessions drag down potential output. So this chart's a little bit complex, but you can see pre-crisis GDP growth is the orange line. Post-crisis GDP growth is the yellow. So you can see there's much, much lower growth since 2007. And then this is the OECD's estimate of what's happened to the potential growth rate of the economy. And that's their estimate of the effect of lower investment and scarring in the labour market, leading to just a lower potential output for the economy. And similar things have occurred to a smaller extent in Australia. So this chart again shows actual GDP growth in the orange. You can see that's many, many years of above 3% growth up until about 2005. Not every year, but very common. And then since 2009, we've only had 1 year with above 3% growth. And many of them are between 2 and 3. So that's actual growth, and then these little black lines, black dots are the OECD's estimate of potential growth, and you can see that's dropped from somewhere in the mid-3s to somewhere in the mid-2s. Okay, so that's sort of that's what's happened. That's my theory about, or my summary of what economists think was driving it. When we look forward then, at a high level, my assertion would be that the outlook is for more of the same. We're not expecting to see a break to those early 2000s growth rates. On the cyclical level, rich world growth could be worse, right? There's been a little bit of an uptick since mid-2016, but still the growth rates are nothing like what we saw in the past. Some real concerns about debt in China. Structurally, we know that the population is ageing, people expecting to live longer, and that will tend to increase savings rates. That's really the only well understood factor. It's also going to make a difference to labour force participation. The big driver in the long term is getting innovations actually into production, and getting that to happen means you need investment. And when you look around the rich world, there's still a big hole in investment rates. Around interest rates, we've already got very low yields on most asset classes. They could go lower, and you get capital growth, but arguably that looks unlikely. And you're only going to get an increase in real earnings if GDP picks up. And then finally, I've got a chart on this. There are plenty of wild cards, but I mean there always are, right? I've got a list of the current set of wild cards, maybe slightly wilder than usual. This is the IMF's account of GDP growth, including their forecasts. Actually, their forecasts have been updated in a minor way in April. These are from late last year, and there's another update coming next week. But the fundamental picture is they're not expecting the rich world to break out to anything like the pace of growth that they'd had in the early 2000s. On inflation, there's hope that inflation is going to pick up again a bit in the rich world, although I've got to say you're not seeing much evidence of that actually happening. I think we'll leave that chart for now. It's clearly not working. So in the Australian context, income growth is probably going to be lower over the next 5 or 10 years than it was prior to 2007. And the main reason for that is that a breakout in productivity growth would have to happen for you to get that high income growth. And I think we all know in Australia, we got a huge boost from our resource price increases in the decade of 2013. And that offset relatively weak productivity growth. And we're probably not going to get that kind of boost to our incomes in the next decade. In fact, it's much more likely that resource prices are going to fall. Yeah. Yeah. Yeah, so that's a huge topic. A lot of people are working on that, and my very, very high level summary would be that if we do get those breakthroughs, that will manifest in very strong productivity growth, and that would be welcome as long as you can manage the social consequences. In the past, we've managed to do that, but it's been a huge historical journey to build a welfare state, and in particular to build a publicly funded education system to ensure that people are able to play a productive role alongside the technology. And so the challenge for society going forward is to understand these new technologies well enough so that we can find a home for people to be productive with them rather than to be replaced by them. And it's not a foregone conclusion how those things are going to play out. There's nothing in the way that the market economy works that tells you there's going to be an acceptable living standard for people with a particular skill set after you get some technology change. Yeah. Maintaining the machines. That's right. But there are obviously new roles get created. I mean, so many people out there in the economy today are doing jobs that had not been invented prior to the technology making it possible. Yeah. Yes. Yes. Yes.
What about the agricultural sector?
Yeah.
Because that's doing extremely well.
Yes. Yeah, and it's part of the terms of trade. So ag prices were strong prior to 2013, and actually they've remained relatively strong. It's not as big as the resources sector as a share of GDP, but clearly it's a material part of the economy, and it's meaningful, and there are growth opportunities. Yeah. Yes. Yes. Now you'll all be going off later today and producing valuable services. Yeah, there are two great questions. So I don't have slides on the population story, but again, my high-level assessment would be this. Yes, Australia is probably among all of the high-income economies the one with the highest population growth, about 1.5%, 1.7% currently. I mean, it dips, right? It was very high prior to 2012, it dipped for a couple of years and it's back up again. My understanding of the studies of what migration does to demand is that people pretty much bring their own demand. So there's very little displacement of incumbent activity when somebody moves to a new location. They'll show up, they work, they spend, it's pretty much a wash in aggregate. Now you might think if they're very similar to the people who they're joining, they're going to tend to push down the wage rate for those people, and maybe that's happening in Australia. I think the biggest effect of population growth in Australia currently is not so much that it's contributing to a shortfall in demand, but that it's helping to fuel those house price increases, because not only current population pressure but anticipated population pressure means that land in attractive positions in our major cities is very valuable because it's expected to remain scarce. And economically, is that a good or a bad thing? I think it depends how much of that land you own. Some people would welcome it and others not. That's right. That's a great point. And I'll come back to the point about interest rates and investment if I can. So the wild cards, for those of you up the back, let me just read out. There's a lot of them. Chinese debt story I alluded to. The Japanese public debt endgame is going to be interesting. The Bank of Japan already owns about a third of the government of Japan's debt. So one possibility is that they'll effectively write that off. And maybe that'll matter and maybe it doesn't matter. German and Italian banks, you saw some big bailouts 2 or 3 weeks ago of the Italian banks. They're still undercapitalised. You've got very low nominal GDP growth, which makes it hard to grow your way out of trouble. Some of the peripheral Eurozone countries are still running bigger deficits than you might like, but they're doing that partly because the European Central Bank has not provided enough support to nominal GDP growth in the Eurozone. At least that's one view. And then I guess the two most topical ones are Brexit and Trump, and those are ongoing. It's hard to say how either of those is going to play out. Will Brexit really happen? I don't know. And then, somewhat to many people's amazement, the markets seem comfortable with Trump. So, a range of wild. Now, let me just turn to what do you do as a policymaker in this kind of environment? So there are two big challenges. The first is, if growth is lower than you had hoped, you'd better fix the budget. If you'd been counting on real GDP growth of around 3 and nominal GDP growth of 5 or 5.5, and suddenly you've got real GDP growth of 1.5 and nominal GDP growth of 3, you better think really hard about how to balance your budget. When you look at the effects, so our assessment would be low GDP growth and low CPI growth effectively make it harder to grow out of trouble, and they will tend to hit the budget because you get less income tax through various routes. There's a lot of wrinkles of funny puts and takes about how the payments work, but ultimately it's probably a bad thing for the budget to have low GDP growth. Certainly makes it more difficult to afford things that you'd like to buy. And then on the interest rates, again, there are some puts and takes, but probably low interest rates are good for an economy for a government like Australia's. It already owes a lot of money, so it's easier to turn over that debt, is the fundamental point. Again, it's got some exposures on the other sides. The big picture, I think our assessment would be, what does this mean? Well, given that Australia's running deficits of 2% of GDP, it's got to figure out a way to get that under control. And those surpluses have just kept on slipping into the future. Now, these sort of charts can be drawn for any macroeconomic variable during a period where growth is lower than people expected. So you could do the same chart for GDP growth. You can do it pretty much for any economy in the rich world. So what it shows is, the dark line is what's actually been happening between 2009 and 2016 in terms of the government deficit. So you can see it's remained about it's zigzagged, but it's currently around 2% of GDP. And then all of those dotted lines are the dashed hopes of forecasters. And you can see even in 2016 there's this optimism. Now, at a certain point, things historically often have they turn around at a certain point and you start to be under forecasting. But certainly the forecast errors have been going on now for almost a decade. You're running deficits of 2% of GDP. That gets expensive because somebody's got to pay the money back. Yep. Yeah. Yeah, that's such a great question. So we worked on this a few years ago, and you would recall that there was a period when Costello was Treasurer when we were running cash surpluses, and the view at that time was that part of that surplus was used to pay down debt, and part of it was judged to be appropriate to essentially let households decide what they wanted to do, right? If they wanted to save, they could save. But part of those surpluses in the later years of that Howard Costello era were significantly buoyed by the resource prices, and if they had factored that in, I think they they should have saved more. So I'd agree with you about that. That remained true for the first couple of years of the Rudd government. And then, of course, with the financial crisis, all bets were off for a year or so. And Rudd and then Gillard failed to get spending under control. Now, the question of why that is a complicated question because it often occurs in resource-rich economies. The only ones that have really got on top of it are Norway. Chile has a very good system for controlling the risks associated with the copper price. And then obviously some of the OPEC countries are pretty strong savers as well. But many of the rest have just got a political economy where there's this irresistible urge to act as if the money's going to be there forever. And even the Treasury forecasts always seem to us to be highly optimistic about what would happen to resource prices after the peak. It looked like a kind of permanent plateau. Yeah.
Surely one of the factors behind this is the exchange rate. If the exchange rate is less than it is now, and it's been creeping up over recent periods, then your terms of trade improve, your local companies that are exporting make more money, pay more tax, etc. How does that?
Yeah. So the exchange rate's a very peculiar beast in the sense that it's subject to these capital market forces which are really separate from the world of trade. And so in a world where interest rates and therefore yields on other assets apart from debt are very low, then even economies that are not affected by the conditions that have led to those low interest rates directly are subject to a force that tends to push up their nominal exchange rate. And so we've had that as a challenge, and it would be better for our local demand if we had a lower exchange rate. The way that the exchange rate relates to the terms of trade is really, the causation is actually round the other way. So the terms of trade change our purchasing power, and that tends to push up the exchange rate when you've got strong terms of trade. And I think it's fair to say that the Reserve Bank had hoped that as the terms of trade tended, with some big zigs and zags, to decline from its peak of 12-13, the exchange rate would be lower than it has proved to be. And I think it's because of that capital market side. Yeah.
You know, that's a chart
So the UK ran deficits of 9% of GDP after the financial crisis. So the scale of the scale is triple what we've had. I mean, even during the Blair-Brown years, which were boom years, the UK was running deficits of 2% of GDP. So we are in control by comparison. Nevertheless, we've been assuming that things will get better. Now, there is a macroeconomic question about, well, if we'd consolidated really rapidly, would we have had slower GDP growth? Right? And that's a very difficult question to answer, actually. We've thought about it a lot. We've talked to a lot of people about it. Some people think it would have made a difference. The other view would say, well, the central bank is typically able to offset. Now, in the current circumstances, when you talk to people at the Reserve Bank, they will tell you, and they've said this publicly, that if they didn't have concerns about financial stability, they would have been more accommodating. They would have cut interest rates even further. And so I think that in this environment, there actually is a dilemma in that if you were to aggressively try to fix the deficit very rapidly, the central bank would not be able to cut rates to offset in the way that they would normally like to, because we don't have good financial regulation. So we've got effectively monetary policy that is constrained by concerns about financial risks, and that in turn makes it more difficult to aggressively fix the budget. So, very quickly on those macro policies. I won't go through all of this because I'm aware of time, but you do have the fiscal policy options on the left. They blur into monetary policy in a way that I'm happy to give you a little bit of information about. And there's a whole range of monetary policy options. Let me just start with the money. You can change the cash rate. You can reduce your positive rate further. You can even go down into negative rates to some degree, and some central banks have done that over the last few years. So they run slightly negative rates because effectively it's inconvenient for people to move their money out and hold it in cash under their bed, and so you're actually able to charge them for the benefit. And that might produce some incentives to invest effectively, but it's pretty unusual territory. Then we've got this world of quantitative easing, which is just another name for open market operations. It's about buying assets, and that potentially can change the incentives to invest again by pushing up asset prices. And then you might want to have a different target. There's been a lot of debate around the world about moving from inflation targeting towards targeting nominal GDP. Effectively, that won't work in Australia because of our resource price volatility. It's quite difficult to target something different. So again, on the far left then, in terms of budget fiscal policy, you can do the tax and spend, but that's hard when you've got persistent deficits. Maybe if you focus on infrastructure bottlenecks, you can get a bit of a payoff for private sector activity. And the final one, so there's this beast that Milton Friedman dubbed helicopter money. That's deficits that are financed by the central bank. So effectively the government runs a deficit, but they don't have to pay it back because they borrow from the central bank. And effectively ex post, that's what Japan's long run of deficits has ended up being. So when you've got the central bank buying up their debt, now they say, oh, no, you're going to have to pay it back, but I doubt it. That's another option. And, economists in Europe that I talk to look back and they say, if you had a different institutional structure, it would have been great in the Eurozone if some of the European governments could have done some money finance deficits for a period, because they've gone through a absolutely destructive period of stagnation. So those are the macro policies. But you can see in the Australian context, you don't really have a ton of scope. Maybe a bit more infrastructure spend, maybe around the cash rate. If you continue to tighten the screws on the banks through APRA, then you can, and on the risky lenders that the banks have already tightened up, but maybe you could do a little more there, and then you can be a little looser on the interest rate. So effectively to try to channel the credit towards productive activity rather than to risky speculation, you could do a bit more on the cash rate. Let me turn to micro though. So we've looked at this extensively in different contexts, different reports over time. There's a lot of worthy microeconomic reforms you could do in this country. Everything from improved aged health, fix some of the urban water providers, invest more in early childhood, price road congestion, build youth participation. There are some tweaks around business deregulation, improve the functioning of VET, the vocational education system, and so forth. But individually, none of those things seem to really drive output much over the next decade. The ones that look really big to us over that period include improving labour force participation and changing the tax mix. And if you did those, they're big reforms. Not everybody's going to like them, and they would boost GDP by a few percent. Now, you spend a while in policy analysis, and as soon as you start to see numbers with more than $10 billion on them, you start to think that is an enormous prize. Even in an economy the size of ours, $1,700 billion, getting an extra 10 is a great achievement, but they're hard to get. I apologise for the size of the font on this chart, but the point of this chart is to show that any given government doesn't produce a lot of really major reforms. That's just the nature of how things play out historically. So we've got Hawke Keating on the left, then Howard, Rudd Gillard, and then Abbott Turnbull. And I've categorised their major reforms into trade and currency, labour, competition, privatisation, regulatory changes and tax changes. And you can see that in any given 2 or 3 year government, you might only have 2 or 3 of these. And so it's worthwhile. Over time, I think Australia has built a pretty good policy environment, pretty good economic policy environment. And so realistically, the idea that there's a huge untapped source of economic growth that we're going to be able to use to fundamentally shift us away from those global trends, I think it's not going to happen. Which isn't to say that it's not worth doing. So as somebody who lives and breathes that world of policy, you're trying to eke out those billions. That's the name of the game, and we do pretty well over time. But nevertheless, let me just give you an example. In trade and currency, it's pretty much all done, right? We floated the dollar, we reduced tariffs. Yes, there's an ongoing battle about free trade agreements, but that's kind of the work. In the world of labour, it's a little bit more murky, right? We've gone from the Accord to a more decentralised system, but we still have a very unusual industrial relations system by international standards. Nobody else has got the 100 awards that cover directly a third of the workforce and indirectly more, but it's actually hard to show that that's a big problem. Of course, you can find instances where it's manifestly inefficient, but showing that there's going to be a huge upside is hard. Competition, we've got a pretty good system already, right? Again, I'm just aware of time. Similarly, we've privatised a bunch of things that you can privatise, and not all of that turned out to be very useful. If you privatise a natural monopoly, you've still got to regulate it. And then on the tax side, there are a few big opportunities with big distributional implications. Yeah.
The black economy.
Yeah. Yeah, that's a terrific question. And so there's a task force working on tax evasion currently. It's not small. Over time, you'd have a hope that moving towards electronic transactions would potentially crimp that a little further. So for example, you go by Uber rather than a cab, for sure that's going through an electronic payment system. But what you get on the worker side, you're kind of losing on the corporation side, because Uber's got a complicated international tax minimiser arrangement. So it's a movable feast, and you're whacking those moles, and you'll never get to 100. I'm not aware of a big single initiative that would make a big difference. Yeah. Well, so we are living in an extraordinary period in world history in which the 1.4 or 1.5 billion Chinese and 1.3 and growing fast billion Indians are experiencing strong economic growth that's dragging hundreds of millions of people out of poverty. And Australia is very well positioned to sell resources, agriculture, education services to those economies. And so in a way, the story for Australia is an extraordinarily positive one looking forward. However, that doesn't mean that these challenges of being in a position that we didn't quite expect, of lower growth than we expected, and low interest rates that have led to some challenging asset market changes, they're not going to go away. But I don't want to leave people with the impression that I'm a pessimist per se for Australia. I think there's huge upside for us in being reasonably well positioned in terms of our endowment for those global demands. So that's the story that I wanted to tell you. It's a story about a fascinating 10-year episode in economic history that we've all lived through. It's not over. That's still posing a hangover for policymakers, particularly around the budget. And I can tell you that talking to people in Canberra, it's challenging doing politics in an environment where the headwinds make even pretty good policy look mediocre to the voters. And I mean, Ross Garnaut said this very presciently a decade ago, that in the salad days, even mediocre policy looks good, but in the dog days, it's the reverse. And that's what we've been in. And I think that's one of the major factors behind our political instability. It's hard to look like a great PM when the headwinds are making it difficult to deliver benefits to the community that they were used to, that seemed to come so easily in the past. So that's the story. Thank you.
Thank you, Jim. You've had a pretty good questions already, guys, but I think we've got another 5 minutes for questions. Yes, David.
So that was the chart that had a mind of its own. The market seemed to expect them to remain low for an extended period. Now that doesn't mean that they won't come up to some extent, but the view of the market seems to be that a combination of those structural and the residual cyclical factors will lead to interest rates remaining low for a long time. Yeah. Yes, sorry. Yep. Yes. Yes. So on the population of the migrants, my view would be that if you want, as an Australian, to benefit people in another country, it's not your job to live with them. Now you may, as a member of a community, decide that you welcome people to join your community. But a community is like a club, and it's got rules, it's got a culture, and the incumbents have got an absolute right to seek to develop the public goods and protect that they've carefully built up over many generations. And so the notion that if I sense a moral obligation to help somebody, I'm obliged to have them join my club, I think is quite wrong. And so in that context, typically the Australian line that says we determine who comes is the right answer. Now you can have that position while actively engaging to solve the problems that have led people to seek a safe place to live. Now in some circumstances, those two parts of the Venn diagram overlap, and humanitarian considerations mean that you must invite some people into your club, at least for a time. And I don't know how to answer those, but clearly they're posing huge strains in Germany and elsewhere. Now turning to your second question about the debt. It's a bit artificial, but it's the right thing to do. That's how I would look at it. So ultimately, you've still got to control the debt, but if you don't have a capital account and a current account as a business, you're going nowhere. You've got to understand your balance sheet, and it's all the more true for government.
One more question. Peter.
Excellent. Great.
I'll ask Norm Griffith to please thank our speaker.
Thanks very much, Jim. Jim, thank you very much for your address. I'd started to make some notes, but I gave up when I realised that Paul over there was taking a video, and I'd be able to get at that at home and go through it a bit more slowly. I think when we all hear, any thinking people, when they hear the name the Grattan Institute mentioned, they all sit up and take notice. Even in the back rows of the stalls, they sit up and take notice. And I think that reaction is going to be justified and reinforced by listening to Jim here today and realising he's a senior member there, and it's certainly a good reason why we should take a lot of notice of what comes out of the Grattan Institute. I think his address has given us far too much food for thought for me to make notes on, and I think it was a real main course. I'm not sure whether we're getting any sweets or pudding out of this. I had trouble picking that out, but I'll have a look at Paul's video afterwards about it. I just wonder why we don't hear more of this sort of information and discussion from our political leaders. We seem to get carried away with personal brawls and arguments that go on, and me being better than you sort of stuff, as against this good gutsy sort of stuff that we should all be looking at and thinking about. And I thank you very much, Jim, for bringing that to us.
A very